this year. Meanwhile, oil prices remain lower as investors closely watch the second round of US-Iran trade talks. Let's get more on this now with Nour Hammoury, Chief Market Strategist at Equiti Group. Now, Nour, Asian trading was mainly quiet to start the week. How much of a window does that give us?
Good morning, and thank you for having me. But it gives us a small window, but it's a thin liquidity window, not a clean signal with the Lunar New Year's holiday shutting or softening or shortening also trading in parts of Asia. Price action can look calmer than the underlying risk really is. The practical takeaway, at least for traders right now, do not overread small moves today. I believe that they should wait for the first wave or real wave with volume when Europe and the US fully re-engage this week, because that's when positioning gets revealed at least, and the real direction trends to show up.
Right, and we are seeing a lot of volatility on the Nikkei, which rallied 5% last week. Are we seeing a healthy consolidation here, or early signs that momentum is stalling?
So far, it looks more like a healthy consolidation after a strong run. The Nikkei is still holding up, even as Japan's latest GDP print disappointed, which tells you dip buying is still there, and the market is leaning on the policy support story. Also, the tell this week is whether gains have broadened beyond the same leadership names, and whether Japan yields and the yen stays orderly. If the yen strengthens sharply or yields jump, that's when momentum can stall. But at this stage, the market behavior still reads as a pause, on hold, and not basically a reversal.
And looking at the US, with softer inflation reviving those Fed cut bets, is the dollar steadiness a sign here that the easing cycle is already priced in?
Definitely, and I would say largely. The latest CPI shows inflation's cooling with headlines up to 2.4 year on year, and the core at 2.5%, and that's basically pulled forward rate cuts expectations. But the dollar staying steady tells you two things. First, markets had already been drifting towards the cuts later this year narrative, and the second, even with the cuts priced, the U.S. still has a relative growth and yield advantage versus many peers. So the dollar doesn't basically automatically fall into a straight line. My added value here also for traders, you have to watch the rate differential, not the headline CPI. And if the U.S. front end yields keeps falling faster than Europe and Japan, for example, this is when the dollar next leg lower becomes more likely.
All right, we'll leave it there for now. Nour Hammoury in Dubai, thank you very much for being with us today.
Thank you for having me.